Hello, and welcome to the 2018 third quarter investment call with the San Diego Foundation. I'm Brian Zambano, Vice President of Development and Stewardship. Thanks for joining us today. Quarterly investment calls are an enhanced service to our donors. These calls provide direct access to our investment leaders in a consistent, convenient, concise format, so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Halbert Hargrove and serves as Investment Chair for the San Diego Foundation Board of Governors. Steve advises a wide range of individual and institutional clients and began his investment management career more than 35 years ago, building his own registered investment advisory business. Steve is immediate past chair of the UCLA Foundation and a founding board member of the UCLA Investment Company, which oversees a $2 billion endowment. As Chief Investment Officer of the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investment. Today, Steve and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio and our long-term, medium-term, and short-term portfolios. We will conclude with a question and answer session. To submit questions, please use the questions chat function located on the webinar sidebar menu at any time throughout the call. Any questions unanswered during today's call will be answered via email. Attendees can access slides and a recording of today's call at our website at sdfoundation.org by tomorrow. Now, Steve Klosterman will get us started.
Thank you, Brian. Appreciate it. And thank you all for being on the call. The call is focused in on quarterly returns as of 9:30, but I'm sure you're interested with recent volatility, more about some comments along those lines. Last week was a really bad week as measured by the S&P 500. It was down 4.55%. For the quarter to date, through last Friday, down 9.27. However, year to date, the S&P was actually positive at 32 basis points. The facts are that's not a bad year. It is not a bad year when you have a positive return in the S&P 500. A bad year is when the S&P is down 10 to 20% or even more. Also, the S&P 500 is not representative of your portfolio. It's only U.S. stocks, and basically it's cap weighted, meaning, for example, that the top 9 stocks in the index are about 22% of the index, and the bottom 335 are about the same weight, 22% of the index. So it's not as diversified as you might think, but it is a measure that you hear in the news. Virtually nobody in the institutional world ever looks at the Dow. It's a price-weighted index, and it's only 30 stocks. So you get a lot of distortion when you look at the Dow. The other thing, if it was up to me, there'd be a law that you can't report points. You have to reference percentages. You can do, if you're going to do points, then you have to do percentages. But the points overstate volatility. Another comment on volatility, the VIX index creation was in 1993, and it's a measure of volatility in the market. It's a little over 22 as of today. Historically, it's a little over 19. So the market on that basis is about 15% more volatile. The problem is that the VIX got as low, I'm doing this from memory, as 9 this year, might have even been 8. So obviously, when you go from 8 or 9 all the way to 22, I mean, you're looking at like 3.5 times the volatility. So it feels a lot more volatile. But if you expand your horizons and look longer term historical, it's only about 15% more volatile. So those are my comments, on the current market. I think at worst case, it's important to remember that the dividend yield on the S&P 500 is 2%, and year-to-date return on T-bills cash is 1.66. So I'd rather get a higher dividend and ignore that volatility and take, say, a 5-year time frame. And I think there's a very high probability that you would outperform cash. So those are my comments on the current marketplace. Why don't we move to some slides that I'd like to emphasize a longer term perspective and a few key points. This slide shows asset class returns year by year, going back, it's basically 15 years and 9 months. So for example, in 2003, emerging market equities were far and away the best performer with over a 56% return, and the worst performer was cash. This goes year by year, so the significance of the color coding is you should notice there really is no pattern there. And in some cases, it borders on the old biblical, the first shall be last and the last shall be first. REITs have periods where they're the best performer and come close to being the worst performer. And in the case of emerging market equities, the same thing. The other significance of this graph is if you look at that 15-year period at the very end, 2003 through 2017, you'll notice risk return is alive and well. The annualized return on emerging market equities, annualized, is 12.7%, so that's per year compounded. The emerging markets equity volatility measured by standard deviation is 23. As you go down, then you can see, again, risk returns pretty alive and well. Emerging market equities, highest return, highest volatility, highest risk. Small cap stocks, second highest return, third highest risk. REITs, third highest return, second highest risk. So that's a reality that we live in and an old adage that you should accept. Let's move to the next graph. One of the things that's hurt your portfolio, but taking that long-term view, at the end of 2007, it would have greatly helped your portfolio. International stocks outperformed for the prior 10 years at the end of 2007, U.S. stocks. Since that time, U.S. stocks have been outperforming. We are very value focused, and research suggests that valuations result in superior returns over the long term. If you look then at this graph, let's just pay attention to those measurements of price earnings ratio, the 20-year average of the price earnings ratio, the dividend yield, and the 20-year average on that dividend yield. And that's compared to international excluding U.S. So that includes both the developed markets and the emerging markets. And you'll see every one of those comparisons is favorable. The international markets have lower price earnings ratio, so better valuations. They have, on a 20-year basis, also better valuations. They have a higher dividend yield, significantly higher at 3.3 versus 2.1. And their 20-year average dividend yields are about 1% higher at 3% versus 2%. So we are long-term investors theoretically in perpetuity. We take a long-term view, and the U.S. is about 25% of the world economy. So there's a lot of smart people outside the U.S. running good companies, and we want to take advantage of that and not just be U.S.-centric investors. On the next slide, there's been a lot of concern about interest rates and interest rate increases, et cetera. This gives you some estimates. Both FOMC stands for Federal Open Market Committee, and that shows their year-end estimates in a diamond-shaped blue. And you can see, looking out, a high of 3.38. However, the market expects that number to be 2.88, and recent history, that's been the case. In other words, the Federal Open Market Committee has not raised rates as much as the market forecasted lower expectations, and they were right, and the Fed overestimated, if you will, what they ended up doing. So at this point, and it'll lead to the next slide, is we're not overly concerned about interest rate and interest rate increases. That's based, if you will, on this next slide, and just hone in on that upper right-hand corner and that notation that when yields are below 5%, rising rates have historically been associated with rising stock prices. The real key with interest rates is what's behind that rising of interest rates. If it's because the economy's strong and the Fed's concerned about overheating, well, then that bodes well. If the Fed is concerned about raising interest rates because they're more concerned about inflation, that doesn't bode well. So you have to look beyond just the rate increases and try and ascertain what's behind the rate increase. But again, this historical graph would suggest you don't get too worried until you see yields at 5% or above. Lastly, coming back to a long-term view, this might be my favorite graph in the business. What this shows are intra-year declines in the S&P 500. So if you look at the first one on the far left, the S&P 500, you see a little pink dot that says minus 17%, and this was in 1980. So sometime during 1980, there was a 17% drop in the S&P 500. Yet the index finished, that's the gray bar, up 26% that year. Now, so you go year by year by year, and what you'll see, all these pink dots represent within the calendar year. Could be a matter of weeks, a few months, a correction, a downturn, a decline. And the significance is they're common. There's a pink dot in every single year, and some of them are very substantial. And to that point, if you look at the very top, it says, despite average intra-year drops of 13.8, so sometime within the year, on the average for this period since 1980, there was a 13.8% drop. We're not there yet this year. And yet, the annual returns were positive in 29 of the 38 years, which is 75% of the time. So you get a lot of false signals if you pay too much attention to an intra-year decline. And we don't do that. We're disciplined investors. We don't try and time the market, go in and out. And historically, about 75% of the time, you end up with a positive return. And in most of the cases, if you get a positive return, you're going to beat cash, which is, supposed to be your safe alternative. But cash has a hard time beating inflation. So I hope this gives you some perspective and a sense of calmness and to take a long-term view. And I think if you look at things in 5 to 10-year blocks, you'll be much more happy with the performance of your investments than if you try and react to 1 year or certainly periods less than 1 year. And with that, I'll turn it over to Matt for some specifics.
Thanks, Steve. Hello, everybody. Again, apologize for giving you dated performance. A lot has changed since September 30th, and we have seen an increase in volatility. We can talk about that certainly more next quarter, but focusing on results here through September 30th, you can see, starting with the endowment portfolio, that we've had relatively good results on an absolute basis. We've struggled a bit over the last year relative to our policy index, which is really an index that measures how well we would have done had we invested purely in index funds. And the story behind that, a big portion of it across all of our portfolios, is what Steve's already talked about. We have more on average than our peers in non-U.S. equities, both developed and in emerging markets. And as you saw from the very first exhibit, emerging markets have delivered some of the strongest performance over that time period, but there is volatility that goes hand in hand with that. So I'd say a large portion of our relative underperformance relative to our policy index has come from the non-U.S. markets. There have been struggles outside of the U.S. in areas like Europe and Japan with weaker GDP growth and certainly weaker earnings growth. But again, we think this is a short-term phenomenon, and that over long periods of time will benefit from this exposure to the non-U.S. markets. The other area that has been a bit of a drag on performance in the endowment has been in the private market segment of what we do. You see the alternative, 19% on the pie chart. A portion of that is invested in private equity funds, where we're taking on some illiquidity, which we can do in an endowment portfolio that has a very long time horizon, perpetuity. And we're hoping to get paid for that illiquidity and take advantage of certain markets or certain segments of the private markets to get a return premium on top of what we would get from the public markets. Our underperformance here, I'd say, is largely due to the life cycle of the private funds that we have invested in. Many of them are in the very early years, and we think that this will reverse course as the portfolio becomes a bit more mature. So let's switch to the long-term portfolio. The long-term portfolio, many of the themes I've already focused on, particularly the U.S. versus non-U.S. themes, certainly apply here as well. The one large difference is that we had one manager that falls under the alternative investment segment that underperformed throughout the course of the year. They're a quantitative fund in nature. They have a strong value bias. And if you look at the disparity between growth and value over the last year, particularly through September 30th, value greatly underperformed growth. The issue we've had with this manager is that as the markets turned in October and November towards more of a value was more in favor, this manager did not bounce back, and we've actually decided to terminate and reinvest the proceeds in a bit of a more diversified fashion. Finally, the medium-term portfolio, it's performed well on an absolute and relative basis. Same themes exist here in the equity segment of the portfolio. Equities are about 30%. This portfolio has, as you can see, a 3.3% allocation to commodities. That's an out-of-index position that we've had. As you know, commodities had really rallied back from their lows in 2016, particularly oil. And as a result, this portfolio has benefited from that position. We have since eliminated that position near the highs for oil in October. And this portfolio is going to be 30% equities, 65% fixed income, and 5% cash. So if you think about the way it's positioned today, it is a very conservatively positioned portfolio. That said, with 65% of the portfolio in fixed income, in the environment we're in, if interest rates were to spike dramatically, we'd feel some pain in this portfolio. But relative to the long-term portfolio, the endowment, much more conservatively positioned. And then finally, I'll just touch very quickly on the short-term portfolio. You can see we quote performance for the short-term portfolio a little bit differently. We show quarterly yields. Remember, this portfolio is invested entirely in money market funds. So you can see the most recent quarter, the yield on the portfolio was 0.5%. If you annualize that into a one-year number, you're looking at a yield just over 2% for the short-term portfolio. So as interest rates, particularly short-term interest rates, have been increased by the Fed, We've seen some higher yield out of this portfolio. Remember, at one point it was yielding pretty much zero. So that concludes my comments. I'll turn it back over to Brian.
Thank you, Matt. Thank you, Steve. Now, we'd like to take your questions. As a reminder, submit your questions for the Q&A. Please use the questions chat function in the menu bar. Our first question is, what has been the cause of the recent market volatility that has occurred since quarter end?
Well, personally, I look at the market as a bipolar person. One day it's politics, and that tends to be negative and creates volatility. And then the next day it's fundamentals, which are pretty strong, and you tend to get a tick up. But again, per the one graph I showed with these intra-year declines, it's common that you're going to get volatility within a year and that the market's going to react. But it seems to me there's an overreaction right now to politics, and people tend to be then paying attention the next day to fundamentals, and then there's a bounce back. So I think you can drive yourself crazy watching the market every day. But that's how I summarize the volatility that we're seeing currently.
Thanks, Steve. Next question is, the U.S. dollar has strengthened significantly this year. How do you think about currencies in the portfolios?
We'll also take that. Back to my earlier comment, at the end of 2007, again, the prior 10-year period, international did better than U.S. And one of the reasons it did was the dollar was so weak in aggregate against those currencies. Some of you may remember saying, geez, I don't know if I want to go to Europe. The euro is so strong against the dollar. These things ebb and flow. Again, we have a globally diversified portfolio. In general, we're not hedging currency, and we would expect, because there's a cost to doing that as well. And so we don't think any investment trends are permanent. That's why we run a diversified portfolio. And it wouldn't surprise me in the least, sometime in the next 10 years, where the dollar is going to be weak against these currencies in aggregate. So again, I think the key is to be globally diversified. Even as large as our stock market is, we're only about 55% of the world's stock market. Remember my earlier comment, we're about 25% of the world economy. So there's a lot going outside the U.S.
I'll just add to that, Steve. If you look at currency over a very long period of time, it tends to have a zero return. In other words, appreciation in the dollar or depreciation in the dollar over a long period of time tends to average out at zero. So given the fact that we have the ability to take a longer time horizon, certainly with our endowment and long-term portfolio, we have the ability to withstand that currency volatility.
Excellent points, Matt.
Thank you both. So our next question is our final question for today's session. If we didn't get to your question, though, today, we'll follow up with an email response. So our final question is, how are trade talks with China affecting the market?
Well, that goes back to my comment on politics. One of my biggest worries is that what's now could be classified as a trade dispute would evolve all the way to a trade war. And I think that in my comment about politics, the number one thing I was indirectly referencing, and I'm glad that question came up, is China and trade. We were talking about the world's second largest economy with projections that it will be larger than our economy sometime in the next 5 to 10 years. And I think I worry about a law of unintended consequences. And the impact on steel prices, aluminum prices, there's a ripple effect. A tariff, as I mentioned, I think in our last call, is a tax. And you have to ask who's going to pay that tax. Either the company pays it, the consumer pays it, and what's the impact if you try and pass it on to the consumer? What's the impact if the company absorbs it? Lower profit margins. If you pass it on to the consumer, maybe lower revenue. So it's a concern, and I think it's a big part of the volatility in the marketplace. If a trade dispute's resolved with China, I think the market will have a bump.
Thank you, Steve. Thank you, Matt. And thank you, everyone, for joining us today and for partnering with the San Diego Foundation to maximize the impact of your charitable giving. Today's presentation will be available by end of day tomorrow on our website at sdfoundation.org/investments. Thanks again and have a wonderful day.